Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey, good afternoon. This is Tech Talk Tuesday. I apologize for some of the background noise, but we're doing this from the Raymond James Wealth Managers Conference in Naples, Florida today. Wanted to make this a poolside webinar, about 85 degrees outside, but we're going to keep it inside. Okay, this is your first time joining us. We're going to talk about market conditions today, look at support and resistance levels, and then concentrate on the sectors which could outperform the market if we're going to have a year-end rally and push back into the plus column for 2015. Despite the slowing growth in China, mixed economic data, another quarter of negative earnings due largely to the energy sector, the market continues to grind higher off the September 29 lows. And different indexes, for the most part, are back to making higher highs and higher lows. The market is very overbought currently. Stochastics for the Dow Jones in the high 90s. Basically, just kind of amazing what a low interest rate environment will do for the market. What we're going to do right now is look at the Dow Jones first. As you can see on this chart, the Dow's back above its 50-day moving average, 21-day moving average. Over here is just crossed the back above the 50-day. And we've retraced more than 50% of the move down from the highs to the August low. When that happens, generally in a relatively short period of time, a stock or index will usually retrace the total move. So that hints that we may be in for a year-end rally, and we'll look at some other indicators that support that case. Okay, technically we're in the back in the bottom part of the trading range that we were in back here from last December to January for most of last year. Since mid-September, every technical event for the Dow Jones has been bullish. We've had a point and figure double top breakout, had a gap up in the diamonds, MACD signaling a bullish trend. And we're going to have resistance now up here probably close to the 200-day moving average. That currently is around 17.568 range. And that could be the last hurdle that we face. Where you're going to break above that and challenge the old highs, or that would be the next stalling point. It would take a pullback probably down to this area around 16.7 to negate some of the positive action we've had over the last couple weeks. Okay, look at the S&P 500. It also looks in good shape. Powerful move off of this September 29th bottom. We are back above the 50-day moving average again. The 21-day moving average is a good part way to cross above the 50. This chart looks like it's going to probably give a challenge up here to the 200-day moving average. There is resistance of 2060 with this area right here. That also represents somewhere around the 62.8% Fibonacci retracement level. But anyway, a move above that 2050, 2060 area, and that could push the S&P 500 up around to the 2100 area by year's end. Only a drop below about 1980 would be a cause for alarm. There's going to be a lot of volatility still in here. So with the VIX now trending down below 15, we may see a little bit less volatility than what we've seen over the last couple of weeks. Okay, here's another one, the NASDAQ. The NASDAQ yesterday bumped up right against the 200-day moving average, right about 49.20. It would have cleared that, but we had a little late day selling in the biotechs, which took off the intraday highs. Okay, we're also trading here above the 50-day moving average. It is overbought. Indicators are all turning bullish in here. The RSI also shows a little bit bought. Here's the stochastics and the NASDAQ. We're also up in the upper 90s on that. This 200-day moving average also represents, almost perfectly in line, represents a 62.8% retracement level from this move down to the NASDAQ also. So that will be formidable resistance. However, once we clear that, it should open the door for a run to about 50.50, 50.85. That would be where this thing could stall out, or if something comes up wrong, that would be where we'd probably fall apart a little bit. Okay, next one we're going to look at real quickly is the Russell 2000. It's not quite up to snuff as the other ones. However, we did outperform earlier in the year with the Russell 2000, and I'd just like to bring up a couple points on why it may be underperforming. Okay, you'd like to see the small caps outperform in a healthy market. But I think it's important to know, why this thing's unimportant, and that is, if you take a look at the iShares in the Nasdaq Biotech ETF, it's off more than 30% and just over the last few weeks. And the Russell 2000 actually is comprised of a lot of these small biotech stocks, and that's been a little bit weighing exceptionally on this index. Take out some of the biotech areas, and I think you'd be a lot higher. You also have the potential here for possibly a reverse head and shoulders, which would measure that back up here around the 1260 area. The next chart over here actually is this iShares Nasdaq Biotech chart. As you can see, from up here around almost 400 down here to this 272.80 was about a 30% drop. It looks like we do have a nice double bottom in here, a little bit of a push off the bottom. It's starting to work its way higher. I would probably look to add positions after this correction or in the healthcare sector. The new treatments that have been discovered by these small techs are pretty amazing. There's going to be a lot of winners in these groups. If you are buying some of those beaten up biotechs, remember, if you don't buy an ETF or a fund, try to buy a basket of several of these small stocks. That way you're not holding one or two of them. Yours don't get approval, the other ones do. It's a smarter way to play a bounce in that. Okay, the last index I want to look at real briefly is the Dow Jones Transportation Index. And if you look at this, several weeks I've been telling you this, it's my opinion, the transport still holds the key to a year-end rally. This index has been in a downtrend since last December. You can see it just moving steadily slower all year long. We've rallied now back above the 50-day moving average. We've also risen above a resistance trend line, which is also bullish. If we can see the transports get up here to this 8,400, 8,450, it's still my opinion that I think we can go all in. I've been saying that for a while. We want to get it up here. Even if crude oil prices continue to rise, that's not going to have that much of a negative drag on the transports, mainly because higher oil prices mean a stronger economy. That means more products to move, and that's going to help the trucking stocks and the railway stocks and that type of thing. Okay, before we look at which sectors could lead us to a year-end rally, I want to take a quick look at some of the internal breadth numbers. We talk about these usually on a weekly basis, and we certainly have had some improvement. The first chart, which is can be found on the Market Edge homepage, if you're not a subscriber, shows the advanced decline line steadily moving down from the highs back in April or May, all the way down here, bottomed in August, came down, put a double bottom in on December 29th, and we've had a sharp rally off of that. So we've broken that trend of lower highs and lower lows. This is very strong. It means a lot of the it confirms that the bottom probably is in. Investors are back to buying stocks. If you look at the Nasdaq advanced decline, not quite as good. We did slide to another lower low. I want to blame part of that on the biotech sell-off again, but we are picking up over here. Kind of going a little bit of a sideways motion. I'd like to see this move higher, but it does look like we have put in a bottom position over here, and we should be move higher, which could confirm the Nasdaq's move higher also. Okay, to wrap this up before we look at some of the sectors and a few of the stocks in those sectors, let's talk about what's happened over the last 8 weeks. Basically, the threat of the China slowing mixed economic data caused the Federal Reserve to push out a rate hike until possibly the first quarter of 2016. Markets sold off, basically in anticipation of a rate hike, and now that's changed. The ballgame's a little bit different. Like it has all year, the low rates have kept the floor under the market. Unless we get some catastrophic number or some kind of world event that I believe the stocks have a chance to muscle their way a little bit higher and return back to profitability for 2015. Most analysts, including myself, thought the market probably would come down here and take out the August lows. But as you can see, especially on the S&P 500, it made a double low and ended up. The Dow Jones didn't even make it back down to the low. So those are that's positive divergence, and again points that we possibly have a good chance of moving higher into the end of the year. what's important is a lot of times the market isn't going to do what you want it to do all the time. So when you are investing in there, you just take what it gives you, and there is no wrong or right. It's going to do what it's going to do, and you just kind of follow along. I think the volatility will be with us for a while. Falling VIX is improving internal breadth numbers are telling us that traders and investors are more comfortable with the market, and it's time to begin to take positions in some good stocks instead of several of these things. Let's look at the sectors real briefly. I want to see which areas of the market are seeing the biggest improvement. Over the last 4 weeks, going back to about mid-September, only the healthcare sector, due to the biotech sell-off, and it was one of the leaders all year long, is now in the red. Okay, leading the market off this August-September bottom, we have the energy sector, which was up about 7.6%. Overbought it here, but a lot of the stocks are down 50% or more in that sector, so it offers some great dividends and on some of the big names. Utilities are up about 6.2%. Holding rates low helps that sector. Consumer staples are up about 5.6%. Materials 5.16%. Technology up over 5%. The laggards are some of the other leaders. Consumer discretionary is up 4.4%. And financials, in fact, have weakened a little bit here. They're up about 4%. Okay, here's the materials spider. We're going to look at here. It again was falling down. It was way underperforming. Broke long-term resistance lines. We've had an intense rally off of the bottom September 29th. We are back above the 50-day moving average. What's important down here is if you can look at this, the F-down ratio. This is averaged out over 50 days. It shows whether or not the stocks in that ETF sector are under accumulation. Okay, in the materials sector, we have gone from 0.61 in September up here to 1.12 in the last month. That means almost double the amount of buying going on in this sector for this rise up, which means it was broad-based. But you look at some of the names in here, chemicals like Dow Chemicals, Sherwin-Williams, SHW has a nice looking chart. For some of the smaller cap stocks, we have Future Fuel, FF looks good, Cabot Corporation, CBT. Several stocks in here that you can start to nibble away at and take positions. If we break through this resistance, we could get a run to the end of the year, back up into this area, maybe to the 200-day moving average. Not quite sure. Okay, the energy sector, another one that's just been a real drag on the broader market. We finally crossed above the 50-day here in the last week and a half or so. Also broke above that descending trend line, which is a positive. Again, if we go down here to the F-down ratio, we've gone from about 0.62 in August to about 1.29 yesterday. Investors are buying these beaten-up oil stocks. Big names like Chevron, CVX, ExxonMobil, XOM. ConocoPhillips has a great-looking chart. COP, Halliburton could be one you can nibble away at. Doesn't quite look as good on the chart. But these should outperform going over the next month or so. They pay great dividends. If you're more of a conservative investor, you have a chance here to buy some of these good stocks down 30, 40%, and cuts down much on the risk. Okay, the next leading sector that we have is the consumer staples. This is up 5.61% off of these bottoms. Nice bottoming pattern in here, and then a breakout above the 200, making a run back towards its old highs. So typically, this is kind of a defensive in nature, but a lot of good-looking charts in this sector. Companies like Costco, COSP. We talked 2 weeks ago about Philip Morris, MO. Great-looking chart. You can buy that anytime. Great dividend. Looks higher. Procter & Gamble's had a rough year. Procter & Gamble's down about 25-30%. It has a great-looking chart now. It's beaten up bad. Pays a great dividend. Another new 52-week high. These are stocks that should lead going out to the rest of the year, especially stocks like Amazon. Seasonally are also strong. Okay, we move to the next one. We have, here's the tech sector we just talked about. As you can see, we just climbed over the 200-day moving average yesterday. I was very bullish for the whole sector. Probably could make a run up here to this resistance area and challenge the old highs for the year. Okay, another sector we want to look at real quickly, not one of my favorites, is the industrial sector. It is underperforming. It's had a nice bounce off of the October or the September 29 lows. It is over the 50-day, kind of playing with the downtrend resistance line. But the reason why it's not one of my favorites is because we still have some some currency problems with the industrials. They get a lot of their stuff overseas, and the dollar is going to keep a little bit of a lid on that. Finally, we have the healthcare sector. Again, this is the only sector that's still down in the red. We have a nice little bottom over here. We're still, we just broke through the downward trend line from here. We are challenging the 50-day moving average right here, but I would be a buyer of this. I think this is showing some accumulation down here at the up-down ratio, not as much as some of the other sectors, so it may be a little bit slower going forward. But if you get into the winning sectors right now, again, the materials and energy, maybe even just for a trade, and some of the consumer staples and technology, they look good. The consumers, we didn't touch the base on the consumer discretionary sector. That's up about 4.4%. That led most of the year. It's pulled off a little bit. The home construction stocks up a little bit. It's not weak, but they are losing momentum. Some of the specialty retailers still look good. Home Depot making a new high. Lowe's close to making a new high. Alta Salon, ULTA, has a nice looking chart. But these former winners, they give way to some of the new leadership going forward, but I think they can be bought in here, and they'll probably outperform going forward. Okay, if you haven't joined us before, we try to keep these with me talking about 20 minutes. Then we try to open it up to some questions. If you have some, you have a little chat box here that you can click on, which will allow you to type in some questions to ask. We can look at some different stocks, look at some different charts. For me, just to wrap it up real quickly, it's looking like what we've had now was just a 10-12% correction. It wasn't the big bear market that everyone thought we were going to go into. Corrections are healthy for the longer term motion of the market. Investors likely put more money to work in here in some of the beat up sectors. That probably will spark an end of year rally, barring out some kind of outside influence from a world event or something like that. Earnings so far have been hit and miss, but they've been lowered throughout the quarter. If they can beat lowered expectations, we should be good. Keep an eye on some of the numbers we've mentioned for the broader indexes for breakout support levels. And with that, let's open it up to some questions. You can type in the little chat box right here where I'm pointing to. I just type in a question and we'll get to it. Okay. I don't see anything coming in at this point. If you have some questions for later on, if you will you can email them to the doc at marketedge.com or even support@marketedge.com, and I'll try to get to them later this afternoon. Again, I hope this wasn't too noisy in the background. We're at the Raymond James Wealth Management Conference down in Naples, Florida. And next week we'll be back in the office, and we'll talk to you then.